What is a TPO? TPO stands for time, price, opportunity. In its simplest form, every single letter on the profile is a TPO. A TPO is a way that we count, it's a way that we measure things. You'll see that very shortly. Okay, let's go and take a look at the value area. How is the value area calculated? You start with the POC, point of control, which is the longest line reading from left to right, closest to the center of the range on the profile. That's a very mechanical definition. But before we show you actually how the calculation goes, I want to make a suggestion. Yes, it's the point of control, but also think of the point of control at the fairest price at which business is being conducted. Thinking in terms of fairest price will help a lot of the concepts we talk about later on, and in the intensive, if you attend one, be a lot clearer. Okay, you can read how the value area is calculated, but I'll show you an example. We said we start with the longest line closest to the center of the range. So that would be the red line right here. We said a TPO is every letter on the profile. It's kind of our way of counting and keeping score. On this profile, there are 110 TPOs. 70% of 110 would be 77 TPOs. So the value area equals 70% of a day's range. And remember, we trade value, not price. So it becomes very important to be able to distinguish the difference between price and value. So the way this is calculated, starting with the center line, which has got 10 TPOs in it, that's 10. We then look at the two lines above, 7 and 7 would be 14. We look at the immediate two lines below, 9 and 9 would be 18. So the first lines we add would be the two below because they're the highest in count. Once that is completed, we now look at the remaining lines above and below. So we haven't used the two lines immediately above, so that's 7 and 7, still 14. The two lines below that haven't been used are 8 and 8, 16. So in order to reach this 70% level, the next thing we'll do is use the two lines with a total of 16. That process continues until you have identified 70% of the TPOs. That's your value area for the day. Remember, the value area starts with the POC. The POC, or fairest price at which business can be conducted, can remain in one place throughout the day. It can migrate higher. It can migrate lower. Being able to stay focused and think about what the point of control is doing will help you keep a good perspective of what is really going on any particular day. Developing value area. Okay, in this example, we see that overlapping value. So in other words, while price went above and below the day on your left, value is pretty much overlapping. So there's really no change in value, nothing to speak of. And that's the way we look at it. Rather than think about price, price is higher. The green circle or bubble up here, that's price. Price is higher. Value is overlapping. So it's a big distinction right there between price and value. Overlapping to higher value. So in this case, you'll see that value is overlapping to higher, as is price. So we've got kind of the same thing on this particular day. So we move on. We have overlapping to lower value. So we're just going in the opposite direction. So we have overlapping to lower value, and we'll see this is price from one day, it's the price the following day. So not only do we have overlapping to lower value, we have lower price too. We don't care that much about price. Remember, our guideline is value. Price advertises opportunity. And, we then look to see where is the value at the end of the day. And value is far more important to us than anything else. So when we see a day like this that the value is overlapping to lower, it means we had a little more pressure to the downside overall throughout the day. Just as in the previous example, value is overlapping to higher. So we had a little bit more pressure to the upside. Now we have an example where value is clearly higher. When value is clearly higher, that's a far more aggressive day. So not only was value higher, but so was price on this day. But it's important. Now, as we go forward, we'll talk about the importance of the shape of these profiles themselves, but not right now. All we're saying in this case, value is clearly higher throughout the session. So it was a fairly strong day when you're looking at value. Now I'm going to show you a real life example of the importance of value. This is an example that led to a trade at the time I was getting ready to record this video. The previous day's value was up here where you see the cursor. The value on this day was overlapping to lower. You'll see that starting with F period, F, G, H, I, J, K, L, and it was M broke later. So you had, these were all one time framing higher. These 30-minute bars were all one time framing higher. One time framing means that the G period low did not take out the F period low. H did not take out the G period low. I did not take out the H period low. So the market is one time framing higher for 2, 4, 6, 7, 8, part of the last period, 8 periods. So, and this is the type of thing that drives, traders nuts. They see price going higher all day, and they get caught up in that, and they start following and trading price. I'm watching this go up, and I'm saying price is going higher in the afternoon, but value is going to be overlapping to lower. I think there's a pretty good chance that these short-term traders are getting the market too long, and as we come near to the close, they may be forced to liquidate, particularly day traders. Day traders by definition, they come in short, or they come in flat, they go home flat. So sometimes they can get caught up with forced liquidation late in the day. And you see this market did break all the way down. And it wasn't a trade that's going to make me rich, but it was a neat little trade. It didn't take very long to develop. As soon as M period started trading above L period, I got into the trade. And you can see, about 40 minutes later, the N period is just a 15-minute runoff period. The market broke pretty hard. And these traders that got long in the afternoon were forced to liquidate. And then when they're liquidating, you get other traders that pile on and start selling the market short. So I wanted to show you this to give you an idea of the importance of value. Remember, if you are looking at price, it was so easy to get misled and think, oh, this market's going higher, it's going higher, I got to get long, I got to get long. I'm looking at it and say value is going to be overlapping to lower. I wouldn't get long for anything in the world. Now, sometimes it does go higher. There's no absoluteness it's going to break. Sometimes it does go higher, but to me, there were two considerations. One, it wasn't worth being long, because if I'm going to be long, I want to see value rising with price. I don't want to see value building overlapping to lower. So one, I wouldn't be in the trade because the odds, even if the trade did go up and it would have been a winner, it was a bad trade because the odds weren't that we were going to get the continuation. It provides a short-term opportunity because it does get too long. Using this idea that values overlapping to lower provides a little opportunity for a trade late in the day. Again, we're not here to take you into trading at this part of the foundational course. All I'm trying to do is add just a little bit of realism to some of the things that we're introducing you to. Okay, before we move on, sometimes you get a double distribution. A double distribution is when the market is trading in one distribution as it is down here in the lower distribution, and then something comes along and changes ushered in, and the market wraps up to the upside and forms a second distribution. These two distributions will be separated by at least one single print. Normally there's more than one. This example's got one, but generally we have one distribution, two distributions. We treat each of these distributions as separate days or auction. However, for looking at overall value for the day, we look at this value calculated including both distributions. But this is just to give you an idea that, sometimes change takes place, and it can take place fairly suddenly. When that happens, then you get a whole new distribution. What I do is when I start a new distribution, I start running a new profile from the period that the market broke to form the new distribution. All right, we've got some other things that we deal with, we're always thinking about in the marketplace. The two most important concepts we deal with are excess and balance. Balance is what you're looking at right here. We got a 2-day balance, and the day 2 is within the total range of day 1. That's short-term balance in there. Now, excess, this E, that's excess for an individual day, but you can have excess relative to the 2 days, excess relative to 3 days, but excess and balance, the two most important concepts we deal with. So in this example, we have balance. This day's range is entirely within the previous day's range. Value is overlapping to lower, but we're still going to take the 2-day balance. Now, we have some balanced trading rules. And, these are not absolute rules, they're guidelines. So when we have balance, the best trades that we normally find are when a market comes out of balance. However, not all trades come out of balance right away. A couple of things can happen. We can look above the balance, above the 2-day balance, and fail. If we look above the 2-day balance and don't see upside continuation, that is a balance failure. At that point in time, the potential destination trade becomes the lower end of the balance. Does that mean it has to go and make that destination? No, it's just something that gives us a guideline to look at and see how well the market is going, how well it's trading as it heads back down in that direction. Okay, the other thing, of course, could be you could look below balance on the 2-day balance, fail, come back in. So if you fail, come back in, this is a chance for a long trade. So you tried to go the downside, you failed, you come back into balance, the destination trade being the upper range of the 2-day balance. A trade may not work, but it's certainly a good opportunity for you to get long, and if you're wrong, if you can't remain within the 2-day balance. So those are just two things can happen with balance. You can fail breaking out to the upside, you can fail breaking out to the downside. If you come along and you trade on the following day and you are still remaining within these 2-day balance periods, this balance of these 2 days, then the next day is more than likely going to be another balancing day. And when you get a balancing day that's inside previous balance, more than likely what you're going to get is a rotational day. In other words, there'll be no real direction to the day. You'll get some rotation to the upside, then the market will trade back down. So you'll get a lot of short-term trades in these days, but there's not going to be a lot of big opportunities. Breaking out of balance, on the other hand, can provide a pretty big opportunity. When you break out of balance, either to the upside or to the downside, and you don't come back in, those are some of the best trades that we ever deal with. Now, sometimes it's difficult for traders to get their mind adjusted to go with these breakouts to the upside or to the downside, because price is going to be substantially higher or lower in most cases. And that's just all they say, I missed the trade, they're afraid to take the trade. You will see with experience that very many times when a trade market comes out of balance, it's a great trade. Why is it a great trade? Something has changed. As traders, we are totally always interested in change. Okay, we just talked about the largest trades very often occurring when we break out of balance. Here we have an example where we break out of balance to the upside. Now, this trade isn't quite as easy as go with a nice breakout of balance. If you see the green dot up here, that's where the market opened after this 3-day balance. So the market opens substantially higher, and then we get some rotation throughout the day, and it comes back down and trades right at the top of this prior 3-day balance. See the single prints? We really didn't find any acceptance back within the balance. These single prints are excess now. So when this happens, you have out of balance and excess combined, and now the trade remains back to the upside. So this is a breakout of balance to the upside, and these are trades you want to go with. You know, sometimes like this example, you're not going to go with it right away. You'll let the market settle. But if the market opened immediately and streaks out of balance on the lower end, you know, on the lower end of this day, you want to go with that right away and take your chances. Okay, we have another example where markets come out of balance. That is when we have a gap. Now, a lot of you probably have been taught that gaps are measured from the previous day's settle. That is not how we measure gaps. We measure upward gaps from the low of the previous day, or I'm sorry, from the high of the previous day to the low of the current day. If it's a downward gap, it's going to be just the opposite. So in this example, the market breaks out of balance to the upside or breaks out of range, gaps higher. That is an indication of change. You'll notice this is the low, this is the opening where the green dot is. And the market never seriously challenged that gap. These are the trades that you want to be able to get long if it's to the upside or shortest to the downside. Change has taken place. The greatest opportunity as traders is when there is change in the market. If you don't get yourself mentally prepared, you will find it very hard to do these trades. These are things you have to become accustomed to and comfortable with. Okay, we're going to talk about some references now. We have two kinds of references. We have static references and we have dynamic references. Static references are fixed, they will not change. The previous day's high and low are static references. The previous day's settle is a static reference. Today's open is a static reference because the open's not going to change. However, then we have other things that will change. As the market starts to go higher or lower, we will see that one of the references that people use is called halfback. It's just the center of the range. And if the market is going higher and then it pulls back, it's not uncommon for it to pull back to half back, and then you'll see what happens at that range. If you pull back to half back and almost exactly at that price and stop, that is probably an indication that we are dealing with weak hands traders. And I've defined that below. Weak hand traders are shorter term players, very short term holding periods, probably poorly capitalized. They are very emotional and easily scared out of trades. You'll also find that they tend to do their trades at very exacting levels. The market for them is very visual. Strong hands are longer term traders willing to hold positions overnight and sometimes considerably longer. They are better capitalized and less emotional. The definitions I'm showing here for strong hands isn't even close to being all conclusive, but you will see that the strong hands traders are not active at exactly half back. They're not active at exactly the previous high or low. They have more trading, their trade size is bigger. They can't wait for those exact levels. The weak hands traders wait for those exact levels very often. That helps me understand who am I competing against, weak hand traders or strong hand traders. Those, you won't pick up on that right away, but as we go on with training and in an intensive course, you will find that information becomes extremely important. Let's look at some other references. Okay, the opening price. We said early on that the opening price is going to be a static reference once it's open. It's the green dot here. Okay, the closing price is the last trade of the day. It's the last trade we see. There is an official price determination made by the exchanges. We trade the ES, E-mini S&P mostly, and the CME has a published price that they put out at the close of each day. You see the line in the middle? That's what I talk about as being half back. That's exactly halfway between the high and the low. That's all there is. All it is to it. Unchanged is also the settle. This was the closing price. It's also known as the settle or unchanged. You will find that weak hands traders pay an awful lot of attention unchanged. If the market goes above unchanged, they get all excited because their quote machines are probably green. If it goes below unchanged, oh, we need to sell it because their quote equipment probably turns red, or some indication that it's positive or negative. It is basically a short-term trader's reference on the marketplace, but you want to pay attention to it. You always want to know, where's the morning high, where's the morning low, where's half back, where's the opening. You want to get to the point where you automatically are recording these levels as soon as the market opens. As you internalize this information, you will find that it becomes much easier to understand what is going on in the market and understand, is it serious money, longer term money that's driving a market higher or lower, or is it trading money, short term trading money that doesn't have a lot of staying power. Those are extremely important concepts and elements for you to work on as you move along the path to become a successful short-term trader. Okay, we said the previous day's high or low. These are examples. We have it for 2 days back. We have it for yesterday. Again, 2 days back, yesterday in here. So these are static references, but they are important references that traders will always know and look at. So you want to be aware of where they are. Obviously, a previous 2-day high is far more important than the inside day 1-day high, or the same with the 2-day low is better than the single day low. This is an inside day. This is another example of a market that's in balance. You're totally contained within the range of the previous day. So even though values are a little overlapping to lower, we look at this as a 2-day balance. Again, it's just a concept that you want to put in your mind very quickly. Another references that we use are the overnight high and low. So the ES trades overnight. In fact, the entire time that the market is open overnight, or from the time of the close, almost to the time of the close, to the following morning. Short-term traders in particular, again, will use these mechanical references. The example that I'm showing you right here happened a day before we were making the current video. So, I mean, we didn't have to go back a long way and search for these examples. But if you will notice that the low, the market made an earlier low, but the pullback low, notice it is almost exactly at the overnight high. Very mechanical. So I would ask you the question, when you see this pullback low almost exactly at the overnight high, who do you think we're dealing with? Do you think we're dealing with strong hand traders, or do you think we're dealing with weak hands traders? You're dealing with the weak hands traders that are using very mechanical visual levels. Notice earlier we talked about the center of the range. If you notice the line just above the yellow line, that is the center of the range. And what you'll see is that the market on several periods pulled back to the center range. This was just a little short, then we had one a couple ticks below it. We had another one exactly on it. When I see that happening, I know that I am dealing with relatively short-term trading. This is not, yes, value is higher. It's actually a gap, but it's not a strong follow-through. So I'm recording it. Yes, it's a gap, but this isn't showing me that I've got strong hand traders on the follow-through. Matter of fact, the following day, this gap was closed. So again, you've got a lot of information to take in, but a lot of it starts with understanding references, understanding the behavior of weak hand traders and strong hand traders. You won't learn it right away, but it will start to come with you over time. By introducing the concepts now, it is easier to start to internalize them as we go forward. Point of control. The point of control is always a relevant point of reference. You'll notice on this day, the normal point of control, we made it 7 wide here, just to give it some numbers. It doesn't have to be 7 wide. The following day, we made 9 wide, we called it a prominent. So we have normal point of control, prominent point of control, and on the third day, we call it a very prominent point of control, meaning it's, in this case, it's 13 wide. This is something that over time, it's not the exact numbers. You just get an intuitive feel for if it's normal, prominent, or very prominent. Remember, another word for point of control is what? It's the fairest price at which business is being conducted. The more prominent the point of control is, that means the more recognition there was that that was the fairest price for that particular day. The greater the odds that we will trade back to that price on the following day or within the next couple days. Does it have to happen? No, but we find from observation that it happens very often. We have other types of references. We have buying tails and selling tails. An example in front of us now, we have a buying tail. So the market opened at the green dot, traded lower, buyers stepped in and aggressively took the market higher. So this tells you this is called excess. We talked about excess before. The market went too low, found buyers, and then the market worked its way higher for the remainder of the day. Very valuable information. Remember, in the auction process, when the market is auctioning lower, it is looking for buyers. If the market goes lower, and it finds buyers, then you will get an excess on the low and you'll find a buying tail. Sometimes the market trades lower and instead of finding buyers, it finds more sellers. In that indication, that means the market's going to be trading substantially lower. Okay, so buying tails, they occur near the bottom of the profile. They are tails because they have a series of single prints. It takes at least 2 ticks to qualify as a buying tail. Now this has several, but it takes 2 ticks to qualify as a buying tail. If there's only 1 tick down there, then we do not have a buying tail. And that is something that we will cover again shortly. Selling tails, as you can imagine, selling tails are just the opposite. The market opened in the morning, rallied higher, and as it rallied higher, the sellers came in. As the sellers came in, they left a series of single prints, and the market traded lower for the remainder of the day. It was pretty aggressive action early in the day. So buying tails and selling tails, they are other references that we want to familiarize ourselves with and use throughout our study of the market profile and short-term trading. Now, we talked earlier about, what doesn't happen. If we only have 1 tick or no ticks, then we have a poor high or a poor low. So in this example, we have a poor high, and that tells us that there really wasn't any completion with that auction to the upside. Not uncommon for the market to come back and take that out. In this example, by the time the day closed, it didn't take it out, but notice that it didn't get a long ways away from that. And I'm going to guess that, in the coming days, that is not very secure, and the odds are pretty good that the market will eventually trade back up there and take that out. That's an auction that was uncompleted on the upside. Uncompleted is evidenced by the fact that there are no single prints. We have, of course, just the opposite. In the example below, we have a poor low, and a poor low means that we have only 1 single tick or no single ticks, that we have no double ticks. Remember, it takes 2 ticks to make a tail, so we have no buying tail in an example like that. Again, that's an indication that that auction is probably not completed. It may not be completed to the downside today, but it may well be in the next few days. You want to make sure that you keep track of that information. We have something else that can take place. We have on the day on your right, we have a good high, and it's a good high because it's got single prints. But it is a weak high because it is 1 tick away from the previous day's high. So again, in one sense, it looks good because it's got single prints. So you have a selling tail. But it's a weak high because it is so exact in relationship to the previous day. Now, we've added another nuance to the equation. What you're going to find as you learn to trade, the real success comes when you have collected and understand a series of nuances. There are continual changes going on in the marketplace. One of the statements that we made, I think in the introduction, or it's yearly carried later on, is that a psychologist made the statement, and he said, for the beginner, anything new or anything new information is kind of that aha moment. For an experienced trader, aha moments come with nuances. So this is a nuance up here. This, I've never heard anybody else talk about this. This is something I think you'll only hear talked about with us. There may be other people that have picked it up now, but poor highs, poor lows, weak highs, and weak lows, they are nomenclature that is pretty common to what we do. You can see that it happens on the other example. Down below, you have a good low because you have single prints, but it's a weak low because it's either exactly at or one tick above or below the low from the previous day. So that's telling you that it's unlikely that this combination 2-day low has been completed. So it's another nuance, it's another piece of information that helps you determine or think in terms of odds of seeing upside or downside continuation on your market. Okay, we're going to look at a combination of a weak and a poor low. Early in the morning, the market trades down. There was a gap. It trades down and fills the gap from the previous day. Notice that initially, A period came down and traded a single tick above the high of the previous day. You got a little bit of rally, and then B period came down and traded one tick below A period. You still have a weak low in that case. So you still have a weak low in there. The chances of seeing upside continuation without cleaning up that combination, it's a weak low and it's also a poor low. And remember, it's a poor low because there are no single prints. Now, on this particular day, it was a very interesting day. And again, it's another great nuance for you to appreciate. I'll give you a nuance in here. And it's very early to give you this, but you may remember it. The harder it is to take out a reference, the lower the odds that when that reference is taken out, that you will see a great deal of downside follow through. So in this example, remember, A period came down, matched the low within a tick, so we had a weak low. A period left some single prints, so it was a good low but a weak low. It rallied. B period comes back down, takes A period out by one, and we now have another example of a weak low. Initially, it was a poor low, but a weak low. It is now a total weak low. The market rallies, and then it comes back down, cleans that up. It gives you a 2-tick selling tail. I'm sorry, it's a 2-tick buying tail. So the market did come back down to that combination questionable lows, took them out. Once it took them out, cleaned them up, and the market began to rally. The market rallied for some time throughout this day. It wasn't a wonderful rally, but again, you've just seen some very important information. Now, again, those are nuances. Remember, an example we're just looking at. First, we had a good low because we had single A period prints on the low, but it was a weak low because it was exactly or one tick above the high for the previous day. Then B period came down and exactly matched the high from the previous day. So we still had just a weak low. The combination of the poor low and weak low is gone. We have just a weak low now because we've come back down in B period and left no single prints. The market rallies and then it comes back down in C period, takes those out, takes out the weak low, leaves a single tick buying tail. You got at least 2 ticks, takes 2 ticks to make a buying tail, and then the market rallied for a good remainder of the day. It wasn't a particularly strong rally and it didn't have a lot of follow through, but from this period on, the market did rally. Okay, again, this is a fairly complex nuance that we've shown you, but it's just to give you an idea of some of the things that we're going to get into and a better idea of what it takes to really be a competitor in this market. You're not going to be a competitor in this market without understanding nuances and without having a pretty good idea of the difference between weak hands, strong hands, understand, how do you make an observation that you're dealing with weak hands or strong hands? One of the things we're going to look at where's value developing? We're going to look at the lows. We're going to look and see if the markets trade exactly to mechanical references. If they trade exactly to mechanical references, we're probably looking at weak hand traders. If they don't even come near those references and they continue on up or down, then you're probably talking at a little stronger hands in control of the market. The stronger hands, the greater the odds that we'll see some continuation to the market.